Hi all, welcome to our fourth session. This session is to discuss about how to make money with options. And in this session, we are going to discuss about call options and how to use them. What are options? An option is the right to buy a stock or other asset at a specified price by a specific time. It has a fixed life from days, weekly options to a couple of years. We also have yearly options. They have a specific expiration date after which its value is settled between the buyer and the seller, the investors, and the option ceases to exist. One option is equivalent to 100 shares of the underlying stock. Let us make this clear with an example. Assume a trader buys one call option contract on XYZ stock. Current market price is $25 with a strike price of $30. The premium for the strike price is $1.50, and as one option is equal to 100 shares, he pays a premium of $1.50 into 100, $150 for the option. On the option's expiration date, ABC stock shares is selling for $35. Let us assume it is selling for $35. He will make around $500 from the sale. That is $35 minus $30 strike price is equal to $5 into 100, that is equal to $500. His cost was $150 and his effective profit is $350. That $500 from the sale minus the cost $150 and the effective profit is $350 from a $150 investment. What a phenomenal return. This is how an option works. What is a call option? A call option is a contract between a buyer and a seller to purchase a certain stock at a certain price up and until a defined expiration date. The buyer of a call has the right, not the obligation, to exercise the call and purchase the stock. It is his right, but it is not an obligation on the buyer of the call. On the other hand, the seller of the call has the obligation and not the right to deliver the stock if assigned by the buyer. So if the buyer wants the stock, then the seller of the call has to deliver the stock. Buying a call. When do you buy calls? Buying a call can be used for speculation. For example, take companies that have product launches occurring around the same time every year. You could speculate by purchasing a call if you think the stock price will appreciate after the launch. The best example I can give is Apple. The product launch is normally around the August time frame. And if you feel the next iPhone is got a phenomenal features and will be a huge success, then you can buy a call based on that. Buying a call can also help you plan ahead. For example, you may have an upcoming bonus or some future income that you would like to invest in a stock today. But what if it didn't come until the following month? So you could plan ahead and lock in the price of the stock today by purchasing a call with the intent to exercise your right to purchase the shares once you receive your bonus or the future income. And the third is not sufficient money to buy a high price stock. Example CMG, Chipotle Mexican Grill. Its current market price is $1,532. To buy 2 shares of Chipotle, you will need around $3,064. But with this money, you can buy one option of Chipotle with a suitable strike price and with an underlying ownership of 100 shares of Chipotle. Buying a call. Key takeaways. Call options give us the right to buy shares. Call option is basically a bullish strategy and it has unlimited profit potential. It has limited loss also. Longer dated calls will have high premiums. Selling a call. When do you sell calls? Both new and seasoned investors will use short calls to boost their income. But more often than not, do so when the call is covered, which means you have the stock against which you have sold the call option. So in case you are assigned, you are simply selling the stock that you already own. Let us take the example of an ABC stock, which is trading at 30 and you sold at a strike price of $35. If the price moves above $35 before or at expiry, there is the possibility of the call getting assigned, which means you will have to give delivery of 100 shares of the stock to the buyer of the call at the strike price, which is 35. So this is how it works in the case of selling a call and if it gets assigned. An uncovered call carries significantly more risk and a potential for unlimited losses because you are obligated to find shares to sell to the call purchaser. Imagine if you had to buy shares which were 20% more expensive than the price you are selling them for. For example, the same example that we discussed above, if you don't have the stock to deliver and the price goes up to 40, then you have to buy the stock at the current market price at $40 and then give delivery to the buyer at $35. So you will be making a loss in the process. And the loss is unlimited because the stock price can go up to any amount on the higher side. Say if it goes to 100, then it's going to be a huge loss. Selling a call. Key takeaways from this. The seller has the obligation to deliver the shares to the buyer if assigned. Selling a call is a bearish strategy. You don't expect the prices to go above the strike price. And it has got the limited profit potential, like whatever is the premium that you get out of selling the call is your profit. And it has unlimited loss because the stock could technically go to any higher price above the strike price. And longer dated calls will have a higher premium in this case also. Now let us see a demo of how to place a call option order. Now you see the Fidelity screen where we are looking at Facebook, which is the ticker symbol is Meta. And now let's place a call option trade on Meta. Okay, now you go under this and you see under news and research and you see options. You click on that, it will open up the option screen. And here you put the symbol Meta, which is currently called as Facebook is called as Meta Platforms now, and it gives you the various options. These are all the weekly options, and if you scroll down further, these are all the yearly options, Jan 2023, and then again weekly Jan 2024, 25. Now let's look at Facebook's results are coming towards the end of October. So let us assume, yeah, I know the current market is not so bullish, it's more like a bearish, but let's assume Facebook is coming out with some phenomenal results and the market is a bullish market. So let's look at November, which is after the quarterly results for a call option trade, as we're expecting the market to become bullish after the results. So Facebook stock price is around $135 now. So let's look at say $150. So we expect Facebook to move from 135, even if it moves $10 or something after the results, still this will go up. It need not touch 150, but as long as it goes up significantly up after the results, this call option value also will go up. So let's look at 150 and click on the ask, which is basically triggers the buy order, and you see the call option order screen as follows. It's basically buy to open. Quantity you need to put one option is equal to, remember, 100 shares as we saw before. Call and the expiration is November 4 2022 and a strike price of 150. The bid is 465 and ask is 490. So limit is order limit order type. We are putting a limit order type, not a market one, and the limit price that we are putting is say $4.50, slightly below the current bid price. We are expecting it to move a little down and then it gets executed. And the time in force, as we saw before in our previous sessions, we have day and good till canceled. So let's choose good till canceled. And the trade type is cash. And you can check it once more. So remember, one option contract is 100 shares. So this premium of $4.6050 gets multiplied into 100. So the total cost is 450 plus a 26-cent fee for the contract. So once you are done, you can click on the preview order button. Now you come to the preview button and you can just verify the information. Buy to open, one call, November 4 at a price of $4.50. Everything looks good. And then you go and click the place order button. And you get a confirmation, buy to order, November 4 call at $4.50. Other videos that are coming up. How to buy your stocks using a brokerage account. This is very useful for beginners and first-time investors. Traditional IRA and Roth IRA, and how do you invest in them for the people who are interested in the retirement investing. Simple index fund investment options. Stocks, mutual funds, ETFs, and bonds, and how to invest in them. Dividend stocks and how to choose the dividend stocks. What are options? The basics of call option, put option, and covered calls. Fundamental analysis of stocks. Technical analysis of stocks using basic chart patterns. Candlesticks like doji and how to use them in your investment. How to measure your portfolio performance. So many more video sessions coming up to teach you a lot on the investing related topics. If you like today's session, please click on the subscribe button and click on the thumbs up button to show that you like this video. Thank you for watching this video and see you soon in the next video. Disclaimer. These videos are strictly for educational purpose and do not provide any advice, tips on investment or recommend buying and selling of any stocks, options, ETFs, mutual funds or bonds. We neither take guarantee of profit nor stand responsible for any losses of any recipient. The recipient of this material should get their own professional advice before doing anything based on this information. The recipient is advised to read the above information carefully before any investment and taking any decision on that.